What's up? Good morning. All right. A couple different charts here. All right. This is yesterday's trades. Let's just remove these strongs and start with a fresh board. This is our pre-market high. This is our pre-market low. We're at the top of the pre-market high. We had a big dip yesterday. This was the take profit I wanted it to be. This was close, but no cigar. So, we're gonna see what happens today. Right now, we're kind of projecting off the pre-market high. We got a big range to the bottom if we want to test this lower again. If we look at a bigger time frame on the daily, we'll see that. There we go. If we look at the daily, we'd see that we're at the bottom of this range. This is a buyer right here. So, is it? Yeah, I don't know actually. I know that this seller is not real, so really you have this seller. So in terms of actual buying and selling that's happening, you could tell that this is your seller right here. So when we come back up, if we come back up, this is going to be where your seller is. And then I believe, if we're looking correctly, by the way, we're breaking out of pre-market highs. If I look correctly, let me think here. This is your buyer right here. Right here. Right here. That's your buyer. So we have the bottom of this guy, which is a buyer. We have this current player, which is a buyer. A real institutional buyer. There we go. And then you have that as a seller. So I'm expecting us to test 484 if we're going to go to the upside. If we go to the downside, we're going to be playing off this bottom range. It's going to be very choppy. And then if this gives, then we could really, we have this last little bounce that we could get here, but we might have to dig into this buyer here. So see what happens. All right, back to the 5. We are breaking out. You see those levels that I drew are on the board. We're going to get rid of those. Just keep an eye on this level. I'll mark it. Mark it something. Mark it with a maybe purple. Just to show you where the fringe of those sellers are. So it'd be interesting just for your own guidance here. All right. What a nice run this morning. Didn't mean to do that. Clean off these ear pads of sweat. It's gross. All right. So let's get into it, huh? A little bit of buyers here. We broke out of the neck of those buyers. This is proving to be really strong. This was really strong buying area. Obviously dipped right off of that. Now we're crossing over. We'll see if the green widens back out again. Find out. VWAP, we're above VWAP, it's obvious, and then volumes kind of dipped on the buyers. So we'll see how this finishes. We're gonna finish strong here. We got 50 seconds left. Looks like volume's actually upticking. So almost beating that second one, which would be a major player for the day if this candle is pretty strong. We'll find out. And we got data at 7. So Fed Powell's keynote speech. Yeah, this is a pretty strong buyer here, so we'll figure it out. The first 30 minutes initial balance, you just don't really know who's actually going to be playing, right? I mean, we could have what looks like a strong buyer and then them just get eaten on the next few candles. So you want to pay attention to that. That's why I kind of changed my rules for the first 30 minutes of the day, because it's just not as profitable, not as clean. This is looking like really strong buying here off the morning. So we'll see how that plays out for the rest of the day. I think your seller is roughly in this area. Yeah, roughly here. Let me see here. This 5 minute. Let's see here. Boom, boom, boom. Yeah, so all of that's selling, honestly. Just put a big dredge here. Would have expected this to go lower. So this is selling intermediate. This is the big selling on the daily. So if we do crack into this area, which it looks like we may right off the cuff, we should just rip right through that and then come up to actually test these sellers up there. So we'll see what happens. Oh man, let us see. Oh, big flash. Is that news? Probably news.
Judge Glam.
Let's see here. Yeah, we got that data from this Powell keynote speech. All right. All right. Let's see if we got that on board here. Hopefully I found the right page to get his stream up and running here. All right. Alrighty. Ripping. Got no entry here, so gotta let this thing go. Right before the announcement, this whole thing can get just eaten back up, man. Be ridiculous. So we're gonna keep going, but need to play the plan here. A lot of saxophone here. All right, we got a third run. Bomb happened here, so this is still your buyer. That's not your buyer yet. Yeah, baby. Let's see what we can do this morning. Yesterday was such a bad day for the strategy. Oh my gosh. I'm so happy I actually wasn't available. I made my first trade in the morning, but I had to jet after that first hand. That saved me a lot of money. It's nice to take those days off. It was horrible taking off a really good day. All right, just chilling. Hanging out in this pocket. We're going to see what happens here. Let's see, probably got a little bit of something here in this little action right here. New aggressor selling, so this would probably be a really channeled position. May get a hot reaction off of this area up here or a little bit below it. Maybe like right here in the 50s. We do have that meeting coming up in about 8 minutes. So keep your eyes on that. We are ready. So not really looking to go short here with this initial strength off the morning. I mean, you could pick some positions to go short if you wanted to front run it, but I'm pretty much only looking to go long right now. Play some continuations in the morning. Minute 25 left. Let's see what we can do here. So yeah, this Express account sitting at roughly 1,600 in profit. Was about 2,000 up, but 2,200 up, but I think yesterday kind of peeled the day off for us. Yeah, 1,668. We had 2 losing days back to back. But Wednesday wasn't supposed to be a losing day, but that's all right. Lost about 600 in the last 2 days. So still up for the week, still up for the month, but it is not up a ton. But we will see. Starting to get a little bit more red. This is where your bounce area should be if we're going to stay bullish. They're aggressive. More bids than asks, especially in this area. It's about even here. I want you to notice that from here, pretty much have a buy imbalance, right? Whereas this mostly bids. Something to take note of. And then here again, you have more buys than sellers, a lot more buyers than sellers. So if you actually get below this area, we're gonna assume that these bulls are trapped. Start to get below it, but something to keep in mind. Same thing with these bulls up here. This is your buyers from the volume profile. This is your buyers from basically the imbalance. You can look at it two different ways. I like to look at it from the imbalance, not the profile. Profile is good though to chart kind of what's going on, but definitely from the profile. All right, 4 minutes, and then we got not Jack. Is it Jackson Hole? No, we're gonna just the Jackson Hole. It is the Jackson Hole speech. All right. Terrible interpreting news, anyways. So. Cutting right through those buyers. We'll see. Cutting through those buyers a little bit. Still can't get involved with these sellers yet, unfortunately. This could just as likely rip back up. So either way, I'm chilling. See how this closes in the last minute. We'll see if we get back above. I'll take this volume profile one off, and we'll just keep the actual standard. See if we actually get above this. So just be algos flushing. But if we can't, we get below it. This buyer just got taken completely. This is why. This is why I say we don't take these in the morning. We're back in pre-market range. The big trap up here. Look at all these bulls trapped. Crazy. Now you got more seller. About even. About even. I wish they would measure it like a median. It's about even. Yeah. $23 seconds left. The buyer algo. So this was a sell algo shoving the price action down, and then buyers were accumulating last second. But now, how much the buyers want to accumulate is going to be found right now in 10 seconds, because it's where this lands, and this is what we call a cold reaction to these buyers. So, see how it got really. Here's Jackson Hole right here. So, Woo! Thought we'd be listening to it. Oh yeah, baby. See if I can find another one somewhere. Cut this music real quick. That's crazy. All right, I need to get. I think the numbers came out.
Policy adjustment may be warranted with rates still restricted. Fed abandoning
This is Josh to answer Stock
flexible
Market Live.
average inflation. That's what he did in 2020. And then says faces challenging downside risk to unemployment rising. So yeah, calls for balanced approach. Prior emphasis on overly specific set of conditions may have led to confusion. That's bullish.
Right here.
Very bullish.
Use your
That's it. They're gonna that way
88 here.
saying they're not gonna even have the same data standard. So he wasn't as clear.
Here's your 488 here.
in
You could probably
terms
take a
of
little
rates. He
little
said,
push
like, he's not
here. If
saying
I was
I'm
on a
gonna cut
different
rates,
account,
but he supports it.
I would take a little
Honestly, the
market sell here, maybe
abandoning of
10.
the new
Order fill.
Right?
framework is
So
better.
put it just a little bit above.
That's the
Maybe
real
take a
bull
little
part
drop
right
off
now.
this purple, which is the
So,
daily.
yeah,
So
man, run it up. I don't know how long it'll last. You're already at 1.2. Again, you were pricing in like $6 on the what's it called?
here's your daily fringe of sellers, but this is a pretty tight stop
right
considering a daily candle.
Average inflation
A really tight
framework.
stop.
That's how they used that. They implemented the framework. That's how everybody fell for the whole transitory bullshit. If you guys don't
All right,
recall,
so there's
'cause
your
they were like,
daily,
well,
and here comes your
we
sellers.
use
So
inflation
really, we're gonna see
on
what these
this
buyers are.
metric
If I go
instead.
to the maybe
Are you understanding?
15 second, kick on some
So,
volume.
yeah.
So yeah, both of these are real sellers, so buyers. I mean, so
Pop, pop, pop.
we could probably get
There's one of
right
those.
here is where we can get a
So,
take
yeah, keep
profit,
your eyes out
probably
it,
for
but
half.
GG's. Oh yeah, the Boeings are starting to come up. Nice.
Yeah,
Okay.
half,
well, one
and
of
then
the
let's see
Boeings
if we
is moving
retrace. What's
now.
a
That's good.
50% here?
Is there another one? But yeah, I want to hear what he says. But so far, I think that's a little surprise. Otherwise, he's neutral. That's my opinion. So yeah, they're adding to September rate cut odds, but like I'm
Wow.
saying, it's
Can't take stable inflation expectations
I
for
think
granted.
the average
Okay.
target, the framework, that was unexpected.
Order
At the same time,
filled.
the balance of risks appears
All right,
to be
that
shifting.
stuff happened. That's why I didn't take it on my live. But yeah,
In my
that's an
remarks
idea.
today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework as captured in the revised Statement on Longer Run Goals and Monetary Policy Strategy
So
that
if
we
we're trading
released
the little
today.
one, we could take an entry.
When I appeared at this podium 1 year ago, the
Order
economy
filled.
was at an
Take an
inflection
entry
point.
here.
Our policy rate had stood
here.
at 5.25 to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth.
Shorts
Over
are
the
really
longer
trying to
run,
get a hold of
changes
this.
in tax, spending, and regulatory policies may also have important implications for economic
They're
growth
getting
and
squeezed though.
productivity. There is significant uncertainty about where
This
all
is
of these
a
policies
bull
will
trap
eventually
on the
settle
5.
and what their lasting effects on the economy will be.
I'm sorry, on the 15 second.
Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed
Gotta
just a
stop
month
out on that
ago,
15
as
second.
the earlier figures for May
This
and
is that
June
the
were
resistance I'm
revised
talking
down
about on the
substantially.
daily. This is where your big sellers are.
But it does not appear that the slowdown in job growth has opened up a
I'm not
large
trading my
margin of
XFA.
slack
That's not
in the
my
labor
strategy.
market,
This is just
an
theory.
outcome we want to avoid.
There's
The
a real
unemployment
seller.
rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little
Not a real
changed
buyer
or have
yet.
softened only modestly,
Just right here,
including
actually.
quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the
Order
break-even
filled.
rate of job
Oh, that's not
creation
right.
needed to
All right.
hold the
Order
unemployment
filled.
rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for
Yeah, I
workers.
kind of want to short it, but
This
they're getting
unusual
squeezed.
situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects
In that
slower growth
resistance,
of
if you're looking
supply
at the
or
5,
potential
it's
output.
right where I said it was. See, right here is where
Turning
we
to
closed
inflation,
underneath it,
higher
right?
tariffs have
This is
begun
where
to
your
push
big
up
selling's
prices
starting to
in
happen
some
at.
categories of goods. Estimates based on the latest available data indicate that
That's a
total
bull.
Order
PCE
filled.
prices rose
Oh, move my stop.
2.6% over the 12 months ending in July.
A bull order.
Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months,
Almost
a
got
notable shift from the
squeezed.
modest
Order
decline
filled.
Did
seen
get
over the course
squeezed.
of 2024.
Wow, so now bulls are trapped.
In contrast, housing services inflation remains on a
That's why I don't
downward
trade on the
trend,
15 second.
and non-housing services inflation is
I'm
still
keeping my eye
running
on the
at a
5-minute on
level
my
a
other
bit
chart.
above what has been historically consistent with the
Boom,
2%
boom.
inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem.
Order filled.
A reasonable base case is that the effects will be relatively
I'm
short-lived,
curious if I
a
can
one-time
do it
shift
on
in
the
the price
15 minute.
level.
Trust me,
Of
this is
course,
not. This is
one
my
time does
strategy,
not
but
mean all at
but
once. It will continue to take time for tariff increases to work their way through supply
this is my strategy on
chains
a
and distribution networks.
what
Moreover,
do you
tariff
call it?
rates continue to evolve, potentially prolonging the adjustment process.
A smaller time frame.
It's also possible,
Much
however,
smaller.
that the upward pressure on prices from
Doesn't
tariffs
work as
could
good.
spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers,
Order
setting
filled.
off
Market is open.
adverse wage
Whoa.
price dynamics.
Whoa, a
Given
little
that
bit
the
of a
labor
squeeze
market is
there.
not particularly tight and faces increasing downside risks, that outcome does not seem likely.
Boom, boom,
Another possibility
boom,
is that
boom,
inflation
boom. Yeah, so we
expectations
get in for
could
another
move
Order
up,
5.
filled.
dragging actual inflation with them.
Yep.
Inflation has been above our target for more than 4 years and remains a prominent concern for
This could just
households and businesses.
straight up rip up
Measures of
all day.
longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows
Not real
us
buying.
to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We
Ooh.
remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual
Order
mandate
filled.
goals. It is designed to give the public a clear sense of how we think about monetary
Dang,
policy.
everything's
And
ripping.
that
Crypto's
understanding is
ripping.
important both for transparency and accountability,
Everything.
and for making monetary
Shooting.
policy more effective.
Straight up.
The changes we made in this review are a natural progression grounded in our
Wow.
ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations, to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a makeup strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the
Three-bar play.
ELB, the post-pandemic reopening brought the highest inflation in 40 years.
Look at that
to
volume
economies around the
kicking
world.
up here. Look at that
Like
volume
most
kicking up.
other
That was
central
big
banks and
absorption.
private
They
sector
got absorbed
analysts,
there a little bit, but
through year-end 2021, We thought that inflation would subside
4,
fairly quickly
3,
without a sharp tightening
2,
in our policy
1.
stance, as this slide
Oh
shows.
yeah, this is 3-bar playing bad
When it
now.
became clear this was not
Technically,
the
you could
case,
take
we responded
limit
forcefully,
buys.
raising our policy rate by
Bar
500
Order
again,
filled.
yeah.
percentage points over
Because this is
16 months.
getting really rippy now. You should
That
get a really
action,
big
combined with the
extension
unwinding
here.
of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that
This
has
is a
accompanied
bit of an
previous efforts to
exhaustion, but I'm
counter
expecting a
high
follow
inflation.
through. Look at
This
that
year's
volume
review
just
considered
Order
ripping.
how
filled.
There it
economic
is. So,
conditions have evolved over the past 5 years.
right.
During this period, we saw that the
Wow.
inflation situation can change rapidly in the face of
I
large
can't even get
shocks.
into this market.
In addition, interest
I can
rates
get
are
into
now
it on the
substantially
15 second.
higher than
I
was the
can't
case
get into it on
during
the
the
5 or
era
15
between
minute.
the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive,
All right.
modestly so in my view. We cannot say
This
for
looks
certain
like
where rates will
an
settle out over the
exhaustion
longer run,
cover,
but their neutral rate may now be higher than
but
during the
I don't want to.
2010s,
I'm not getting in
reflecting
front of it.
changes in productivity,
Oh,
demographics, fiscal
that
policy,
flip
and
was
other factors that
crazy.
affect the balance between saving and investment.
So this is actually 2-1.
During the review, we discussed how
Order
the
Take that.
2020 statements
Take
focused
that. Throw
on
a
the
little stop on
ELB
it.
may have complicated communications about our
We
response to high
should go
inflation.
2-1 on this.
We concluded that the emphasis on an overly specific
What is this?
set of
This
economic
is
conditions may have
15,
led
so
to some
30
confusion,
from
and as a result, we
the
made several
45 total.
important changes to the consensus statement to reflect that insight.
All right,
First,
52.25.
we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of
Woo,
operating
look at that
near
absorption.
the
That's
ELB
crazy.
remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the makeup strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived
Big slapper.
a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021.
Yeah, that's a real seller.
Well-anchored inflation expectations
See.
were critical to our success
Order
in
filled.
bringing down inflation
Oh,
without a sharp increase in unemployment.
dang.
Anchored
wild.
expectations promote the
This is your
return of
algo right
inflation
here,
to
so we
target
should
when adverse
land
shocks
somewhere
drive
right here.
inflation higher, and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored to the benefit of both sides of our dual mandate. It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the
All right. Well, we got what we wanted. Gold's ripping right now. Just crazy. All right. Let's see some of this. There we go. All right. Could have taken a short here. Or let's see, 1, 2. Oh, not yet. Not yet. Bottom of your bounce.
Order
So
filled.
you should get a little pull here, and then set a tight stop like right here. And your pull would be right here. This is where the other seller should be. Right here.
Order filled.
Boom. Yep, we're not having any trades in our live yet. We're just playing around here. We do look at the live, as I've been keeping an eye on it. We have a couple different nodes here. Big imbalance, cut right through those sellers, and we're entering the fringe of these daily buyers. So starting to sell off a little bit. I'm assuming we're going to test this level here, 8350 and beyond. So this is your stack here, this whole bar. I think ICT people might be looking at either the order block zone, something about this, and then also fair value gap right there, which, you know, call it either or. It's a big stretch here. This is your imbalance here. Nothing I can do. So I'm gonna go back to the 15-second, and we're just gonna chill. Oh, I have to actually run here really soon. XRP's 4,600 right now. I'm sorry, not 4,600. Ethereum. Oh my gosh. All right, we're dropping now. See what happens when we react off these buyers. This is looking pretty bearish. All right, well, I can't take any pulls here. 322 points. Nice. Garov, sick, dude. How big was this candle? You went long? Right off the break? That's wild. I haven't even gotten to any trades yet. Broke that high, though. It ripped. Oh. Oh. I'm trying to look for some continuation here, hopefully.
even ahead of FOMC, you don't really care about which one. You just read price action. Can't believe crypto's ripping so hard. We're chilling. Might get long here a little bit. Oh, what time is it? 7:27. All right, I got to get out of here. Catch you guys next time. No trades this morning yet, but